Hey, this is attorney Elizabeth Potts-Weinstein, and today we're going to talk about if you have a business with multiple owners, more than one owner, should you be a partnership, an LLC, or a corporation? So let's first talk about partnerships. A general partnership is the default if you go into business with anybody else and you don't form something else. It happens automatically. You're going to want a partnership agreement, but it happens automatically, even if you don't create a partnership agreement, if you kind of don't do it on purpose. But what does that mean? It's a general partnership means that every single person who is in that partnership is personally liable for that business. This is a very, very, very dangerous type of business entity, because what it means is if one of your partners goes and gets a $100,000 loan for something on behalf of the business, you're liable for that now, personally liable for that. If two of your partners signed a lease, that's a 10-year lease, you're personally liable for it. You don't have to have been the one to sign things because they did on behalf of the partnership. This can create a lot of risk for people. And this is one of the reasons that as soon as it's logistically feasible, we want to get away from general partnership and form some kind of other entity. Now, one of the entities sometimes people consider is a limited partnership because that sounds better. You're limiting liability. But here's the problem. A limited partnership means that most of the partners only have limited liability, but there has to be one general partner. It is very rare where that will be the correct type of entity for you. If it is, then you'll probably know that you're in some special situation. Most of the time, it doesn't make sense because you, as the person who's like running the business, who would be the general partner, you don't want to be personally liable for all this stuff. Also, for example, if you form a limited partnership in California, you still have to pay the $800 a year franchise fee. You still have to do a bunch of other filings. It doesn't make any sense when you have the next option available, an LLC, a limited liability company. So an LLC, a limited liability company, does what it actually sounds like. It limits liability for everybody who owns the business. LLCs are also very flexible. You can structure them differently so different members have different amounts of vote. So you can have some members who have a minority share in the business such that they don't have power to run things. That works really well if you have people who are just investing in the business and not running the business on a day-to-day basis. You do have to file something with the state to get that limited liability company, that LLC. But you limit liability. And that's the wonderful thing. For everybody who's an owner, you're not personally liable for what happens with the LLC. So if it takes on debt, if it gets sued, whatever, you're not personally on the hook. Now, another option is to have a corporation. You can have a corporation that's taxed as an S corporation or taxed as a C Corp. S Corps can make a lot of sense because there's a lot of flexibility in taxes, and if the business it's passed through a tax entity. So if the business is taking a loss, you might be able to take it as a deduction on your personal tax returns. And you can pay yourself both a salary as well as distributions that are not subject to self-employment tax. However, for an S Corp, all of the members have to be either permanent residents of the United States or US citizens. That means there's a lot of people where that won't work. C Corporation is going to be a bit more complicated, have more tax liability. However, it can make a lot of sense for businesses who are looking for outside investors. If you're pitching venture capital, if looking for angel investors, a C Corporation is typically what they're going to be investing in. And so if you haven't formed one yet, you might end up needing to switch to a Delaware C Corp anyway. The bottom line, if you are forming a business with somebody else, whether it's one other person, even if you know them really well, or many, many other people, I generally recommend an LLC is going to be the way to go to limit your personal liability for the acts of the other partners. The only exception really is to have a C Corp if you're looking for outside investors like VC and angel funding. Now, just by the way, side note, you can have an LLC that is taxed as an S Corp or an LLC that is taxed as a C Corp and get some of the tax benefits of a corporation while keeping to the simplicity of having an LLC. So I just wanted you to be aware of that. So you can start out with an LLC that's taxed as a partnership, and then change to an LLC that's taxed as a corporation when you need more tax planning. Again, this is attorney Elizabeth Potts Weinstein. If you have any questions about whether or not a LLC is the right choice for your partnership, feel free to ask it below and I'll try to point you in the right direction. Thumbs up if you found this video helpful. Subscribe if you'd like to get more videos like this, and join if you would like to support the channel so I can make more videos like this. Thanks a lot for watching. Bye-bye.